A single structural shift on the daily chart can reveal where the market is preparing its next directional move. Yet most traders miss it completely because they chase breakouts or react too early to short-term fluctuations. The truth is, the real signal comes from how market structure forms and retraces after liquidity is taken. Look at this chart and ask yourself, are you trading the move or the setup behind it? By the end of this video, you will understand a clear framework for identifying daily bias, confirming retracements, and executing trades with precise structural timing. Let's get started. So when applying the daily bias framework, the process begins on the daily chart. What we are specifically waiting for is a swing high to form and then be broken. That event signals a bullish condition. When a swing high is taken out, in other words, a candle that has a lower high to its left and a lower high to its right, with the highest point position in the middle, just as illustrated here. If price later trades through that level at any point in the future, that situation establishes a bullish stage in the market. In simple terms, we begin anticipating a future buying opportunity. This does not mean entering a trade immediately. It simply places us on alert to wait for a very specific set of conditions. The next requirement is to observe the formation of a swing low down here. A swing low again refers to a candle that has a higher low on the left side and a higher low on the right side. And remember, this evaluation is still being done on the daily chart. The important detail here is that this swing low must not violate a recent previous swing low. So if this condition appears immediately after a swing high has been broken, then we now have what is considered a probable optimal trade entry scenario based solely on the daily chart. This does not require the setup to align with the 62% to 79% retracement level. Instead, it simply means we are effectively trading a higher low after a short-term high has already been broken. So what we now have is a break in market structure followed by a retracement. And because of that sequence, the market should have the potential to produce upward momentum. Once the swing low forms, we begin watching the third candle, this one here. What we want to see is the high of that candle being traded through on the following day. In other words, when the next trading day begins, preferably we want to see it open below the high of the third candle that formed the swing low. So here is the full criterion. You want the swing low to form without breaking a previous swing low, immediately after a swing high has already formed and broken a previous high. So once again, the stage for a bullish scenario occurs anytime a swing high is broken and price trades to a new high. At that point, you expect a retracement. Then you wait for a daily swing low to form. That swing low should be higher than any recent short-term swing low. The third candle that forms the swing low becomes important. Its high is the level you want the next candle to open below. And then you anticipate the market trading through that high. From there, we begin targeting previous day highs. Each day we expect price to potentially raid the prior day's high until a new swing high forms on the daily chart or price reaches a major support or resistance level. Let me show you what that would look like. The immediate candle following this daily formation becomes our bullish opportunity. In either the London session or the New York session, we would anticipate a move toward the previous day's high. On the next trading day, we repeat the same idea. We look for reasons to remain bullish. If price retraces lower and then continues higher, it will eventually reach this old high. This area represents resistance. If price trades to that level and moves through it, we continue maintaining a bullish outlook. We keep looking for opportunities to buy as previous day highs are taken out. However, if price rallies toward that level or even before reaching it and forms a new swing high, then we must wait again for that swing high to be broken before considering additional trades. Admittedly, this approach will cause you to miss some opportunities, but it provides a very clear set of criteria to operate within. So if your objective is to find one solid setup capable of producing roughly 25 pips, you really only need one quality scalp. Think of it the same way as building toward a weekly goal of 50 pips. If your scalps are structured around targeting 25 pips, then technically you only need 2 setups per week. Now for the short-term or intraday trader, the highest probability days are typically Tuesday and Wednesday. For a weekly objective of roughly 50 to 75 pips, if I can achieve that target in a single day, then I will not trade again for the rest of the week. Regardless of which day it occurs, however, most of the time the focus is placed on Tuesday and Wednesday, because historically they tend to produce the most reliable movement. If the weekly expectation is bullish, then you would anticipate the weekly low forming around Tuesday or Wednesday during the New York session. If the expectation is bearish, meaning you anticipate a lower weekly close compared to Sunday's open, then Tuesday or Wednesday may form the high of the week. When you trade in alignment with this concept, it naturally builds stronger conviction and confidence in the setups you take. Especially when applying the framework we are discussing here, it is a relatively simple approach. And although the diagram may appear like an oversimplification, the key idea is how you mentally interpret the marketplace. When this pattern appears on the daily chart, there is a strong probability that the move will sustain for several days. But the important thing is that you only need one trading day. So if the scenario is bullish or bearish based on the criteria already explained, chances are you will get one day of strong momentum. And that is enough. Also remember that currency pairs do not always move in perfect synchronization. One pair may present a high-quality opportunity today, while another pair may offer the better move tomorrow. The setups are always available, but you must allow them to develop naturally in price action on the daily chart. Avoid forcing trades. Now let's move to a chart example so you can see what this looks like in real conditions. And we will also incorporate the kill zones here on the daily chart. The exact starting point is not important, but focus on the price action in this area. We will examine this swing low right here. It forms immediately after a short-term high, so we have a short-term high here, lower high to the left, lower high to the right, and the highest high in the middle. Price breaks that level. So now we are on buy watch for potential scalping opportunities. Since the swing high has been broken, we now wait for a swing low to develop. After the upward run, we expect a retracement. As price begins to decline, we first see a preliminary swing low here. This candle becomes the third candle in the structure. We must wait for price to trade through the candle's high on the following day. But it does not happen immediately. Then another potential swing low appears here. Now this candle becomes the one we watch. Again we wait for its high to be traded through. The next candle does not do it, but this one does. At that point we can consider a buying opportunity. The objective would be a scalp targeting the previous day's high, which is located right here. This candle becomes the location where we look for the setup. Now we drop down to a smaller time frame. We will use the 15-minute chart. With the daily dividers applied, you can clearly see where liquidity is resting. This is the liquidity pool. That becomes our target on this trading day. We are specifically looking for a long opportunity to run that liquidity. Again, the objective is this liquidity pool. We expect price to reach the high of this day. When applying market sessions, the primary focus is the London session and the New York session. This here is the London session low. Notice the timing. It forms during London. Now we use that reference. And this becomes the highest portion of the day based on a 15-minute candle. We use these 2 points to frame the price movement. Price begins the day here. We are not concerned with anything until price moves into the optimal trade entry zone, which is the 62% retracement level. Price eventually trades into that area. This candle forms precisely at that level, and it occurs during the London session. From there, price begins a strong move toward the previous day's high. That alone produced a very clean scalp. The move offered approximately 10, 20, 30, even 40 pips as price approached the high. If we allow for an additional 10 to 20 pip sweep above that high, the range expands even further. Now we are looking at roughly 20 pips, 40 pips, or possibly even 70 pips of potential movement. And realistically, that alone could complete the objective for the entire week. At that point, there would be no reason to continue trading. It may sound surprising, but this is exactly how you should approach the market. You do not need a large number of setups each week. The goal is to execute one thing correctly. And this framework allows you to do exactly that. For a more conservative approach, you could simply enter within the optimal trade entry zone and target the previous high. For example, if an entry occurred around this level, and the exit was taken near this level, that would produce roughly 37 pips, which we can round to about 40 pips. At that point, you would only need one additional trade producing 10 pips to reach a 50 pip weekly return. That's it, traders. Thank you for watching. I hope this explanation delivered greater clarity and practical insight that you can apply to your own trading. Make sure to subscribe and turn on notifications so you never miss future content. Leave your questions and suggestions in the comments section below, and let us know which topics you would like to see covered next. We truly appreciate your support, and we look forward to seeing you in the next episode.